Hey everyone, welcome back to Corporate Decoder. Today, NHP just filed an 8K about a new credit agreement and preferred stock redemption, and I am seeing a couple of big moves that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is making some pretty significant financial maneuvers that could signal a shift in their strategy, especially around their debt and how they are handling their preferred stock. National Healthcare Properties Incorporated, or NHP, has been busy behind the scenes. This filing talks about a big change in their borrowing power and a move to get rid of some of their preferred stock. It looks like they are reshaping their financial structure. So first up, the company, along with its operating partnership, has signed a new credit agreement. Think of this as their new loan contract. This agreement significantly boosts their borrowing capacity. They now have a $1.2 billion credit facility, which is a big jump from their previous agreement. This includes a revolving credit line that went up from $400 million to $750 million, and a term loan facility that doubled from $150 million to $300 million. Plus, they've added a new delayed draw term loan facility for another $150 million. What are they going to do with all this extra money? They say it is for general business needs like paying off other debts, buying real estate, funding new developments, and general operating expenses. This increased access to funds suggests they are planning for growth or perhaps consolidating their debt to get better terms. Let's talk about the cost of this new debt. The interest rates can be based on a base rate or SOFR, which is a common benchmark rate. The important part here is how the interest rates change based on the company's credit rating. Initially, the rates are tied to their leverage ratio, but if they achieve investment grade status, meaning they are considered a safer bet by credit agencies, the rates can actually go down. This gives them an incentive to improve their financial health. For example, before they become investment grade, rates on revolving loans can range from 1.05% to 1.55% after they achieve that investment grade status. Those rates could drop to between 0.65% and 1.35%. This is a pretty significant potential saving. Now, all this new debt comes with rules. The agreement has what are called covenants. These are basically promises the company makes to the lenders. They restrict things like how much more debt the company can take on, what they can do with their assets, and how they can spend money, including paying dividends. They also have to meet certain financial targets, like a minimum fixed charge coverage ratio and a maximum leverage ratio. This is standard practice for large loans designed to protect the lenders. They do have a bit of a safety net though, with a cure right that allows them to inject cash to fix certain covenant breaches. The other big news in this filing is about their preferred stock. National Healthcare Properties is planning to redeem, which means buy back all of their Series A and Series B, cumulative redeemable perpetual preferred stock. They have over 3.2 million shares of Series A and over 2.8 million shares of Series B outstanding. They are buying these shares back for $25 per S-share, plus any dividends that haven't been paid yet. For the series of preferred stock, this works out to about $25.32 per S-share, and for the Series B, it is around $25.47 per S-share. This is a pretty standard buyback price for preferred stock, often set at par value plus accrued dividends. What this means for the holders of this preferred stock is that after the redemption date, their shares will no longer exist and they will no longer receive dividends. They just get their cash payment. This move likely aims to simplify the company's capital structure and potentially reduce their dividend payout obligations. By redeeming these shares, they are essentially retiring that part of their equity. The company has included a lot of standard forward-looking statements here, warning that these plans might not happen exactly as described. They mentioned that the actual completion of the redemption could be affected by various risks, like changes in market conditions, their ability to manage debt, and general economic cycles. This is just boilerplate legal language to protect themselves. On a different note, there is a change in the board of directors. Albert M. Campbell is joining the board. He has a strong background in finance, having served as Chief Financial Officer for Mid-America Apartment Communities, a large real estate investment trust, for many years. He also has experience as a certified public accountant. The board sees his extensive experience in real estate investment trusts, capital markets, and accounting as very valuable. He will also be joining the audit committee. This appointment seems to be about bringing more financial expertise to the board, especially given the significant financial maneuvers the company is undertaking. His experience, particularly with another REIT, is a clear signal that the company values that kind of background for its leadership. Overall, National Healthcare Properties is making some substantial financial adjustments. They are increasing their borrowing capacity significantly, which could fuel growth but also increases their debt load. Simultaneously, they are simplifying their capital structure by redeeming their preferred stock, which will reduce their dividend obligations. The addition of an experienced financial executive to the board suggests a focus on sound financial management during this period of change. The risk I am watching is how they manage this increased debt, and if the redemption of preferred stock is a precursor to something bigger, like refinancing or a strategic shift. My biggest concern is ensuring they can handle the new debt obligations while continuing to grow the business. What I am actually looking for is how these moves impact their profitability and cash flow over the next few quarters. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please like and subscribe and join our community in the Discord linked below.